Most people who've built $10 million plus businesses don't really think of themselves as wealthy. They actually think of themselves as builders. And that's exactly the problem. I'm Chris McClure, and for 30 years, I've worked with people who've built something significant. They've built businesses that employ dozens of people and generate serious wealth. The clients who get the most value from our approach, they understand protecting what they've built requires the same level of thought that they use to build it. But builders, they do something predictable. They'll spend months analyzing a $500,000 equipment purchase. They'll negotiate every little detail of a vendor contract. They know their cash flow. They know their margins. They know it down to the decimal point. Estate planning is a different story. They think that a trust document that was designed 12 years ago is going to protect a business that's tripled in value. A big binder full of documents, it's not really a strategy. And like I said, I've been doing this for 30 years, and what happened to this person, Todd, it still gets to me. Todd built 12 auto body shops across 3 different states from scratch. He had 1 location in his 30s, and he had 12 by the time he was 60. He had $18 million in revenue. He had really strong margins. He had employees that had been with him for years. Todd was methodical. He was strategic. He was the kind of guy who thought through every decision. And when we met, he thought he had everything covered. He had trust documents. He had a buy-sell agreement. He had everything. He figured he just needed a quick review, maybe some minor tweaks. We showed him some significant gaps. He had outdated valuations. He had conflicts between his buy-sell and his trust, and he had some unsigned agreements. But Todd decided to stick with his current setup and said he'd probably be fine. So he actually never became a client. You see, what most generalist advisors don't tell you is that having estate planning documents drafted by a good law firm isn't the same as having a coordinated strategy. You see, Todd's trust was 12 years old. His business had more than tripled in value, but nobody bothered updating the valuation. He'd moved everything into an S Corp for better tax treatment, which makes a lot of sense. But the trust paperwork still showed the old LLC structure. That buy-sell agreement, unfortunately, it never got signed. And his original partner, who had left the business 5 years earlier, was still on the paperwork. It still had him down as 50% ownership. And so unfortunately, when Todd died suddenly of a heart attack, his business turned into a legal mess. The trust supposedly owned the business, but the S Corp language said something different. His wife was named successor trustee, but she wasn't listed anywhere as a corporate officer. And the bank, it froze their line of credit while everyone tried to figure out who could actually sign checks. Employees panicked, vendors stopped shipments, and the IRS, well, unfortunately, they triggered a full audit. The IRS looked at the numbers and said, it's a nice try. The business was actually worth $11.2 million, not the $4 million on the old paperwork. So there were taxes, penalties, and interest of nearly $1.2 million. His wife had to sell their lake house just to pay the tax bill. It took 2 years to unwind everything, and the business eventually sold, but it sold at a 40% discount just to stop the bleeding. He had 12 locations, he had hundreds of employees, and he had been working in that business for decades. And it was dismantled because the plan, it really was an illusion. On the other hand, we have Carla. Carla built a medical device distribution business with $12 million in annual revenue. She had a lean operation and excellent margins. She really wasn't ready to retire, but she understood that her adult children, they just did not want to run the business. Instead of hoping that it would work out, she decided to build the transition into her wealth strategy before she needed it. And what most either attorneys, CPAs, or advisors don't tell you is that the biggest risk isn't outdated paperwork. It's assuming your family actually wants what you think they want. So we restructured her business ownership through a holding company, and we created a grantor trust to gradually transfer over non-voting shares to her children. That gave her a huge valuation discount on the business. And more importantly, it kept future growth out of her estate while she stayed in control. So we coordinated the trust structure with a comprehensive buy-sell agreement, including using life insurance that would provide liquidity without forcing a fire sale for the business. She also found a potential successor from her industry, someone with the experience to step in if needed. And they structured a 3-year earn-in process so her team would have stability and continuity. A few months ago, Carla called me after a friend had passed. This friend had passed unexpectedly, and I could hear the relief in her voice when she said, "I finally understand why we went through all of this. I can sleep better knowing that the plan, it's real. It's not just paperwork." You see, there's a world of difference between documents and strategy. One family ended up in probate court fighting tax disputes and liquidating at a discount. The other has a coordinated wealth preservation system that protects the business, it maintains family harmony, and it optimizes taxes, all without giving up control. You see, this level of coordination is complex. You can't just phone it in. And if it sounds familiar, maybe it's worth having a conversation about your situation. You don't really need to have everything figured out, but sometimes it just helps to talk with someone who's seen this before. And you can sign up for a phone call in the chat below. I hope this was helpful. I really do enjoy making these, and I'll see you on the next one.